Today, we're pulling apart small and mid-sized business valuation myths, the kind you hear in owner circles and broker listings, and sometimes even from well-meaning advisors. And then we're going to rebuild the topic with models and metrics that actually help you price, buy, or sell an SMB without fooling yourself.
And just to level set, we're not talking about valuing a pre-revenue startup where everything is a story and a slide deck. We mean real operating businesses, cash coming in, expenses going out, customers churn or renew, equipment breaks, staff leaves, and taxes are very real.
Exactly. So let's start with the myths. Myth number 1. My business is worth a multiple of revenue. People love revenue multiples because they're simple, and simplicity feels like certainty.
But in SMB land, revenue can be a vanity metric. 2 companies can each do $5 million in revenue. One has consistent gross margin, repeat customers, low refund rates, and clean financials. The other is project-based, inconsistent, with discounts, late payments, and a bunch of one-time jobs. Same revenue, totally different value.
So the truth is, most SMB deals are priced off earnings or cash flow, not revenue. Revenue can be a secondary reference point, but it's not the driver. If someone quotes you a revenue multiple, the next question is, okay, what's the margin profile and how stable is it?
Myth number 2, valuation is objective. Like there's a single correct answer. There isn't. Valuation is a range shaped by risk, deal structure, financing terms, and who's buying.
Yeah, value isn't just a number, it's a negotiated outcome. If a strategic acquirer can cut costs or cross-sell, that same business might be worth more to them than to a purely financial buyer.
And even among financial buyers, the same company can be worth more if the seller offers favorable terms, a seller note, training support, or earn-out based on performance. Which brings us to myth number 3, price equals value.
Such a good one. In SMB acquisitions, the headline price can be misleading. A $5 million deal with $2 million paid over time and contingencies is not the same as $5 million cash at close.
So you have to look at the real economics. How much is paid upfront, what the interest rate is on any seller note, what performance hurdles exist, and what happens if the business dips after close.
Myth number 4. Add-backs make the business worth vastly more. Add-backs are real, but they're also where fantasies go to hide.
For anyone new to the term, add-backs are expenses the owner claims are discretionary or non-recurring and shouldn't count against earnings. Things like a one-time legal bill, maybe an owner's personal car, or personal travel running through the company.
Some add-backs are legitimate. Some are not. The key question is, if a new owner takes over, will that cost truly disappear? And if it disappears, does something else replace it? Like, sure, the owner's salary might be added back, but a real operator still needs a general manager or has to pay themselves something.
Also, non-recurring expenses have a funny way of recurring. Repairs, compliance, software migrations, recruiting fees. SMBs are messy. A clean adjustment is one you can defend with documents and logic, not vibes.
Myth number 5. The multiple is a multiple, like it's some fixed industry constant. 3 times for times, 5 times.
Multiples move because risk moves. Customer concentration moves it. Dependence on the owner moves it. Gross margin stability moves it. The quality of financial reporting moves it. The ability to finance it moves it.
Okay, myths covered. Now let's talk about valuation truths and the models people actually use in SMB settings.
The workhorse model is an earnings multiple. In small business deals, that usually means SDE, seller's discretionary earnings. In bigger lower middle market deals, you'll hear EBITDA more often.
Let's unpack those quickly. SDE is basically the cash flow available to one full-time owner-operator. It typically starts with net income and then adds back interest, taxes, depreciation, amortization, plus owner compensation and certain discretionary expenses.
EBITDA is closer to operating profit before financing and accounting non-cash items. It assumes you're valuing the business as an enterprise with a management layer, not necessarily an owner doing everything.
And this difference matters, because if you're a buyer who plans to be the operator, SDE might better represent your reality. If you're buying something with managers in place, EBITDA becomes more relevant.
Here's a practical truth. SDE numbers can look bigger than they feel in real life, because a buyer might still need to hire help, upgrade systems, or spend more on marketing than the current owner does. So even if SDE is the pricing basis, smart buyers mentally stress test it.
So how do you pick a multiple? You don't pick it like you're choosing a number off a menu. You earn it through risk assessment. Let's list the risk drivers that commonly push multiples up or down.
First, customer concentration. If one customer is 40% of revenue, that's scary. If the top 10 customers are each 5% and sticky, that's safer.
Second, revenue quality. Recurring revenue, contracts, subscriptions, maintenance agreements, repeat purchase behavior. That's worth more than one-off projects where every month starts at zero.
Third, gross margins and their stability. High margin doesn't automatically mean high value, but consistent margin usually signals pricing power, predictable costs, and fewer surprises.
Fourth, owner dependence. If the owner is a lead salesperson, the operations manager, and a relationship glue, then a buyer is buying a job plus a risk. Documented processes, trained staff, and distributed knowledge reduce that risk.
Fifth, financial clarity. Clean books, accrual accounting where appropriate, consistent categorization, and a believable bridge from tax returns to internal P&Ls. Bad reporting doesn't just annoy buyers, it drops the multiple because it raises the odds of unpleasant surprises.
6. Working capital needs. Some businesses consume cash as they grow because they must fund inventory or receivables. A business that ties up cash might be profitable but still feel expensive to buy because the buyer has to inject more capital.
And seventh, growth runway. Not I could grow if I tried, but demonstrated channels, conversion rates, unit economics, capacity expansion, and a market that supports it.
Now let's talk about a second model, the discounted cash flow or DCF. People hear DCF and think it's only for big public companies. In SMB, DCF can be useful, but it's fragile because forecasting is hard.
Right. In a DCF, small changes to growth rate or discount rate can swing the valuation a lot. So it's less about the answer and more about understanding what has to be true for this price to make sense.
A practical way to use DCF in SMB is scenario modeling. You run a base case, a downside case, and an upside case. Then you ask, if the downside happens, do I still survive the debt payments? Do I still want this business?
Which leads into a third approach buyers actually use, financing-based valuation. Especially with SBA-style lending, the deal has to cash flow after debt service and still pay the owner a reasonable income.
This is where a lot of listing prices get exposed. A seller might say, it's worth $4 million. The buyer asks, with current interest rates and typical down payment, can the business pay the loan and still leave enough for me to live on and reinvest? If not, the price gets pressured or the structure changes.
So in practice, many SMB valuations are constrained by debt service coverage. If the lender needs, say, a comfortable cushion, the business's normalized cash flow sets a ceiling on what it can support.
Let's make this concrete with metrics. If you're an owner listening, here are the numbers that tend to move valuation discussions more than you think.
Number 1. Normalized earnings. Not your best year, not your worst year. Something a buyer believes is repeatable. That might mean a trailing 12 months number adjusted for real add-backs and realistic replacement costs.
Number 2. Gross margin by product or service line. If you can't explain what you sell to whom and what it costs you to deliver it, buyers assume the worst.
Number 3. Customer acquisition and retention signals. Even if you don't have fancy dashboards, you can track lead sources, conversion rates, average order size, repeat frequency, churn, and cohort behavior.
Number 4. Customer concentration and contract terms. Who can leave quickly? Who is locked in? Are prices adjustable? Are there service level penalties? Buyers model risk from those terms.
Number 5. Working capital cycle. Days sales outstanding, inventory turns, and payment terms with suppliers. This affects how much cash is trapped in operations.
Number 6. Operational capacity. Are you bottlenecked by one person one machine, one vendor, or one location. Bottlenecks can limit growth and increase fragility.
And a big one, management depth. If the business can run without the owner for a couple weeks without chaos, that's not just nice, it's valuable.
Let's also talk about quality of earnings, even though that phrase sounds corporate. In SMB, quality of earnings just means, are the profits real and durable?
Exactly. A business might show strong earnings because it deferred maintenance, underpaid staff, ignored marketing, or leaned on a one-time contract. A buyer wants to know what earnings look like after you run the company properly.
Let's do a quick lightning round of owner statements we hear, and the buyer translation.
Owner says, we could grow a lot with more marketing. Buyer hears, growth is unproven and will cost money.
Owner says, our margins are great because we don't need salespeople. Buyer hears, sales is probably founder-led and not scalable.
Owner says, I work on the business, not in it. Buyer says, show me the org chart, SOPs, and who owns vendor relationships.
Owner says, we have loyal customers. Buyer says, prove it with retention and concentration data.
Now, we should talk about model selection. If you're valuing an SMB for a sale, you might start with a market multiple approach because it aligns with how buyers talk. But you should sanity check it with cash flow and financing reality.
And if you're buying, you should do it in the opposite direction. Start with what the business can responsibly support in debt payments and owner income. Then see what multiple that implies. If the seller's ask implies a fantasy multiple, you know the negotiation you're walking into.
There's also asset-based valuation, which matters for certain businesses. If equipment, inventory, or real estate is a big portion of the value, you don't want to ignore the balance sheet.
But most healthy SMB acquisitions are about buying future cash flows, not just stuff. Asset value can be a floor, but the ceiling is usually earnings power.
Let's talk about the most common valuation trap, confusing profitable with financeable. A business can be profitable and still hard to finance if the cash flow is volatile, customer concentration is too high, or the reporting is messy.
And that hits the seller in a painful way. Fewer qualified buyers, longer time on market, more retrades after diligence, and ultimately a lower realized price.
So if you're an owner thinking ahead, the best valuation improvement projects usually aren't gimmicks. They're boring operational upgrades, clean books, documented processes, diversified customers, recurring revenue, and a team that doesn't collapse when you take a vacation.
Let's end with a simple checklist anyone can use, buyer or seller. First, define the earnings metric you're using, SDE or EBITDA. Don't mix them casually.
Second, normalize earnings realistically. Validate add-backs. Include replacement costs. Assume you'll need some reinvestment.
Third, choose a valuation method set. Use at least two lenses, a market multiple lens and a cash flow or financing lens. If those are wildly different, dig into why.
Fourth, stress test the business. What happens if revenue drops 10%? If the top customer leaves? If labor costs rise? If you have to spend more on marketing to keep growth?
And fifth, treat deal structure as part of valuation, not a footnote. Terms change risk, and risk changes value.
If there's one takeaway, it's this. Valuation isn't about finding a magic multiple. It's about understanding cash flow, risk, durability, and what the next owner needs for the business to work.
Next time you hear a confident claim like, this type of business always sells for X, you'll have the right follow-up questions. And those questions are what separate a smart valuation from a hopeful one.
That's it for today. If you're buying or selling and you want a deeper episode on how to normalize SDE, or how seller notes and earnouts change the math, we can do that in a follow-up.
Until then, keep it simple. Clean numbers, honest assumptions, and a model that matches reality.